Yeah, I mean, it's definitely, is US growth accelerating? We're seeing the Fed normalising interest rates, so they're starting to do rate hikes. And this is, we've had one rate hike a year for the last 2 years, and then this year they're looking like they're going every quarter. So that's a big change. We've had 8 years of near zero or negative interest rates in the big markets in the world, Japan, US, Europe. People haven't seen interest rates rise for over a decade of any consequence globally. So we're coming into a period right now where what happens to the world when interest rates start to go up, and this Tim's got a very strong view on the US growth story. It's going to be the catalyst.
Yeah, I think you could say the really big thing is you've exited a debt deflation cycle that's very long duration, so an 8-year event, into something that's approximating a more traditional cycle. So it's about sequencing which economies are moving through that cycle and who's first. The US was presenting it as they're well and truly first. They're at full employment. In fact, they're accelerating through full employment. We can already see wages are rising. In fact, the very poor in the US are getting wage increases. The older part of the workforce are finally getting some wage increases. And it's coming through in some real hotspots across the economy. So we think the Fed cares more about that than temporary factors that have held down the inflation indicators in the early part of this year. And we think that's going to be far more important in how they go about thinking what they do next. The second thing that's really important is that they're also flagging that it's time to start to shrink their balance sheets. And that's a super important event in terms of what that means for all asset classes. And I think the really important aspect about that is, how do you make money if you think that equities are already pretty well overvalued, bonds are very expensive, what do you do next? And it's really only, I think, strategies that can try and make money in that sort of environment. It will be a rising volatility environment, it'll be a shift in correlations across major asset classes that'll succeed over the next little while. Yeah, so the market got reasonably excited about the idea that the US was accelerating through the last part of last year, and as we moved into the early part of the year, the data started to disappoint a little bit. And there's some reasons for it. It was an incredibly cold and period, so that created a bit of a pothole for the data. There were some issues around tax receipts, there were some issues in seasonality in the first part of the year. And the markets followed that all the way down. What we think is really interesting is that when we sit there and try to map where the economy appears to be accelerating into Q2, it's looking like it'll print well over 3% at an annualised rate. And it'll probably hold at that rate, we think, for the next couple of quarters. At the same time, when you've got the measures of the unemployment rate not just moving lower, but gapping well through any measure of full employment. So you get inflation pretty much when you're approaching full employment, but also the rate that you approach it. We've gone through full employment and we're accelerating through it. So a lot of the wage measures we think are picking up on various different ways of looking at it, and in various different locales, but the rate of trajectory is very clear. And ultimately that's what generates underlying inflation. Looking at some of the other things we think are important, there's been this really big debate about whether the survey evidence, the soft data, would be supported by the real. And even though we've printed a weak Q1 GDP print, the evidence that's starting to come through that the real data is accelerating, industrial production is accelerating to meet where the surveys have been, for instance. That's really important. It gives the policymakers some confidence that the underlying economy is on. It was very a transitory event in terms of Q1, and the underlying recovery is still occurring. The last shoe to drop in all of this is CapEx, and whether we're actually seeing the managers and the owners of capital willing to deploy that into real assets. There are some pretty interesting early indicators that that's already occurring. If the Fed starts to see that en masse, they'll know they're actually a little bit behind the curve. So it's a little bit similar to what we've had in previous Fed tightening events. The Fed's giving very clear guidance what their objectives are. The market is not believing them at the moment. If the data comes in the way that we think it will in Q2, Q3 of this year, the market will have to reassess. There is even a prospect, as the New York Fed governor has suggested, that even if they do start to shrink their balance sheets, they may well keep going with rate hikes even in Q4 if it doesn't cause any disruption in markets. So yeah, we think the market, well, the broader consensus of where economists think what the Fed's going to do is a little bit misplaced from the evidence and the data, but also for the evidence what the Fed's actually telling them. It's not that dissimilar of a setup to 94 in that event.